We will discuss some very contemporary topics during the course of this week, which includes asset securitization, credit derivatives such as credit default swaps or CDS for short, and other structured products such as collateralized debt obligations called CDOs for short. In the next couple of sessions, we will look at asset securitization, and the other topics will be discussed in the sessions thereafter. First of all, let's look at the definition of asset securitization. Asset securitization is the process that transforms financial assets such as loans into a security that can be traded in the financial markets. The security that results from this process is typically called asset-backed securities. The former chairman of Citibank, John Reed, has very comprehensively defined asset securitization as the substitution of more efficient public capital markets for the less efficient, higher cost financial intermediaries in the funding of debt instruments. Let's try and unravel that definition. Traditional bank lending, as we all know, requires a financial institution to A. originate a loan, B. fund that loan through deposits and other liabilities sourced from customers, C. service the loan, that is, process the monthly repayments, etc., and D. monitor the loan for timely repayments and initiate early corrective action in case the borrower defaults on the loan repayments. In securitization, the process of sourcing the loan by the financial institution remains exactly the same as before. However, the loans, either singly or packaged to create a portfolio, are sold to investors in the financial market. The financial institutions that originate the loans continue to discharge the responsibility of servicing the loan in most cases. The monitoring function in the context of securitization acquires a more complex dimension, as we will see later. Asset securitization was conceived several decades ago to resolve some very basic issues embedded in several markets for loans around the world. First of all, banks and other lending institutions, by virtue of the nature of their business, have a large physical and virtual presence that customers have ready access to. Hence, they are very well placed to originate loans, in particular home mortgages, automobile loans, corporate loans, credit card loans, and so on. Most of these loans are long-term in nature. However, the liabilities such as customer deposits that are sourced by banks and financial institutions to fund these loans are short to medium term in nature. Hence, these institutions run an implicit interest rate risk and liquidity risk on their balance sheet all the time. The process of securitization enables them to sell these long-term loans, and consequently the embedded interest rate risk and liquidity risk to those participants such as insurance companies and pension funds in the financial markets whose liabilities are long-term in nature. As a result, securitization markets have grown significantly from the time they were conceived and launched in the 60s right through to today. More recently, these markets have grown in an uncontrolled and unregulated manner on the back of several credit enhancements such as credit default swaps and structured products such as collateralized debt obligations, details of which we will see in a later session. Such uncontrolled and unregulated growth of these markets eventually resulted in the 2008 global financial meltdown.